I'm Sean Aylmer, and this is Fear and Greed's Sunday feature interview. I'll be back again tomorrow with another weekday episode of Fear and Greed, the normal mix of business news and interviews that sets you up for a successful day. In the meantime, enjoy our Sunday feature interview. We talk a lot about traditional lending on Fear and Greed, but today I wanted to look at the world of alternate lending. Compared to traditional finance, alternate lending in Australia is still only in its infancy. Today is an opportunity for me to find out more and find out whether it's going to be a major part of the financial services industry in years to come. Alan Greenstein is the Chief Executive Officer and co-founder of Australian alternative lending platform Zagga. Alan, welcome to Fear and Greed.
Thank you, Sean. Thanks for inviting me.
First, let's start with the basic. What comes under the umbrella of alternate lending?
Oh, that's a good question. Let's explain this in its most simple form. Anything that is not traditional lending, that is lending that you would get from a bank, comes under the umbrella of alternate or alternative lending. Now, once you then accept that basic definition, then within alternative lending, there are a number of subsets. And the two most important subsets would be unsecured lending, which would be personal loans or business loans, genuinely unsecured or secured by a personal guarantee. And then the other component would be secured lending, where the security would be in the form of property.
When we talk about things like peer-to-peer lending and that, how does that all fit in?
So peer-to-peer lending is a form of lending. And I guess, to be honest with you, peer-to-peer lending was the original form of lending all those years ago when lending transformed from being pure barter to being money. One individual would lend another individual some money. That was peer-to-peer lending.
A bit like a parent lending a child money for a card, that type of thing, really.
Well, that maybe wouldn't be so much peer-to-peer, but you lending your friend some money to do something with it, or you lending your friend some money to buy some goods, which he was going to sell, and him then returning you the money with a level of interest. Now, all that's happened in terms of peer-to-peer, and in Australia, they tend to call it marketplace lending rather than peer-to-peer lending. And marketplace lending then gives you the real answer, is where you create some kind of platform or portal which allows many people to fund a loan to one person. So the peer-to-peer lending is the funding of a loan to a particular borrower by one or many people using some form of digital platform or portal.
Okay, so we have the marketplace, we have secured and unsecured lending. Now, the difference between that is that someone has a right over property, is what you said.
Yes.
I presume there's a difference in cost between secured and unsecured lending to the borrower?
Yes, for sure. So clearly there's a much higher level of risk when you're dealing with unsecured lending. So the level of interest rate that would be charged for an unsecured loan is generally much higher than for a secured loan. And in the case of both of those, they would generally be higher than the kind of rates you would expect to pay if you were going to a traditional lender. Now, for unsecured lending, those rates could be in the tens, in the very high teens, even into the 20% per annum, depending on the nature of the loan and the nature of the lender and the nature of the borrower. And from a secured lending point of view, those rates could be anywhere from 5 to 15%, again, depending on whether it's a first mortgage security or a second mortgage security or the nature of the structure that is being employed.
Okay, so where does Zagga fit into this picture?
Zagga is a registered first mortgage secured lender only. So we lend money to borrowers who are able to give us a first mortgage security over their property. We don't do unsecured lending and we don't do second mortgages. Every one of our loans is a first mortgage. But having said that, we are reasonably agnostic as to the loan purpose, provided that you're going to use the money for purposes that are not illegal. Mm-hmm. In other words, for any legal purpose, and provided we can get the right level of real property security for you, we can give you a development loan, a construction loan, a non-construction loan, a cash flow loan, etc., etc., etc.
Okay. So if we stay with the big picture, who tends to use alternative lending in Australia?
I think that if you'd asked me that question, maybe a decade ago, I think the alternative lenders were always considered to be the lenders of last resort.
Yeah.
The users would have been those people who couldn't qualify for bank loans. Today, that is very, very different. I think that since the Royal Commission into Banking of 2018-19, since COVID, since the various stresses and strains that the banking sector has been put under in recent times, most of the borrowers that we see are bank-grade borrowers who are having difficulty getting their bank to meet their requirements for any number of reasons. So today, the average borrower, certainly I think in the secured lending market, is a bank-grade customer whose needs maybe don't fit into the specific and strict requirements of the bank at that specific time.
Okay, I mean, just to unpack that a little bit, because of changes by the bank regulator, APRA, in recent years, the risk profile has changed from banks, and I'm saying this, but please correct me where I go wrong here, Alan, so that banks are actually looking for lower risk customers, and if they go for the higher risk customers, the cost of capital them is much greater. Is that fair to say? And so as a result, what you've sort of found is you would never call them high risk customers, but they're just not as low risk, are suddenly looking into this sort of marketplace.
I think, Sean, maybe risk is one component of it, but I don't think that that's the primary component. I think from the bank's point of view, the pressure they've received from APRA and from other sources has required them to tighten up their procedures quite considerably, which means that it takes much, much longer to maybe for them to approve the loan as they would have done previously. Secondly, they have perhaps changed their credit standards so that the kind of loan you could get previously is now not so easy to get now. And thirdly, could simply be because banks have changed some of their product definitions, and your product requirement used to fit within their definition, but no longer fits. So the classic example of that would be, say, a property developer who used to do property developments for $8 million roughly, and the bank now decides that they're only doing property developments for more than $10 million.
Alan, we'll be right back. My guest today is Alan Greenstein, Chief Executive of alternative lending platform Zagga. So what are the typical loans and loan sizes in the alternative lending sector, and then for you guys, for Zagga?
So I think in the alternative lending sector, if we're talking about unsecured, and obviously this isn't my space, but let's just deal with it for the sake of completeness, unsecured runs anywhere from $25,000 to perhaps $250,000. A lot of those would be unsecured business loans, and you would know the names: Thin Cats, Prosper, On Deck, etc., etc. And that would be the classic range for the unsecured market. In the secured market, you get those guys who are doing predominantly residential stuff, and that would go anywhere from in the low hundreds of thousands to perhaps $1 million or $2 million. And then you get the higher end of the market where private lending can go all the way up to 50 or 100 or even $250 million. From a Zagga perspective, we tend to focus between $5 and $25 million.
I mean, they're big loans.
They're chunky loans. They're certainly nothing to be, nothing to shy away from in terms of being a lender. I mean, these are bank grade deals.
Given low interest rates, has that helped the sector? Simply because, I mean, whilst the relative interest rates are higher than a bank, they're in absolute terms not as high as they might have been a few years ago.
So I think that from the borrower perspective, the reduction in rates over the last year or year and a half has perhaps helped the borrower in that psychologically the borrowing rate looks a lot lower. But to be honest with you, I think the margin between a bank loan and a private loan is very much the same.
Yeah.
So the margin has been maintained. I think on the other side of the balance sheet, from an investor point of view, the reduction of about 1.5 percentage points over the last year or 18 months in returns has certainly brought a lot more investors into the alternative market because they're searching for yields. And if you consider that today, maybe you're getting 75 basis points on a 12-month term deposit, and you can earn 6 or 7 or 8% on a private loan secured by a registered first mortgage, while you definitely have an element of risk, that is a very, very decent return by comparison with whatever you're getting in the market.
Yeah, so I'll actually unpack that in a moment. Before we leave the borrower, you mentioned in terms of time taken to get loans through and that. So presumably borrowers also are using alternative lending, not just based on rate, but lots of other things too.
I would say it's less based on rates. I think the fact that the borrower pays the rate is because you're meeting a need that he has much quicker than anyone else can. So let me perhaps give you an example that happened to us just a few weeks ago. We had a particular borrower who bought a property in Newtown, and they bought the property on 90-day settlement. They're a bank-grade borrower. They have a number of transactions with their bank, and the property was slightly unusual in the sense that it had a very large frontage, quite unusual for the area, and had been used for a specific purpose, again, quite unusual for the area. Commercial purposes, but kind of not your common or garden. Mm-hmm. So they went to their bank and they asked their bank to finance the loan, and it wasn't a particular large loan. It was about $2.5 million. On 90-day settlement, with 5 days to go before settlement, the bank hadn't said yes. Just because it was hard for their credit guys to get their head around the slightly different characteristics of the property, and it goes up and down. The loan was brought to us on a Monday. It had to be settled by the Thursday, and on Thursday morning, the money was paid and everything was done. And I can tell you that our credit process and everything else is as robust, if not more robust, than you would expect. But we just deal with it with alacrity, with speed, and with efficiency. Now, that bank has now eventually gotten its head around the deal and is now ready to take us out. So the borrower had nowhere to go. He's happy to pay the money because he doesn't want to lose the deal. If you're a property developer, paying 3 or 4 more percent in the context of your property development and a 30%, say, profit margin or 20% profit margin, that interest cost is really neither here nor there in the larger scheme of things, but you've got your money quickly.
Okay, so that's the borrower side. Now, obviously, Zagga has to have the money to lend out, and that comes from your investors. So tell us a little bit about your investors and why they do invest with you.
So, Sean, when we started this business, the logic for the business was really very simple, and that is that you have a massive property market in Australia. I mean, you can read lots of statistics. It's hard to get the right one. But there's a view that the property market in Australia, residential, commercial, industrial, the overall market is worth about $900 billion to $1 trillion a year.
Yep, okay? That's second only to superannuation, is that right?
Second only to superannuation. And on the other side of the coin, you have 1 million self-managed super funds in this country. And most of the money in those super funds actually sits in the bank. Yep. Generally, a self-managed super fund trustee will put his money on the market, but the market has its own issues, and a lot of people are scared of the market only because they don't have the time to watch it every day. They may put their money into managed funds or other kinds of investment funds that are offered to them, which is fantastic, but a lot of their money sits in cash. And in fact, when I looked at this, in around 2015, 2016, there were trillions of dollars sitting in cash in the banking system of self-managed super fund money.
Which effectively are getting very low returns, is the point about the cash.
And 4 or 5 years ago, they were probably getting 2.5%. Now they're getting less than 1%. So our logic was to say, we don't actually want to start a lending business. We'd really like to start an investment business. And we'd like to target self-managed super fund investors. And we feel that the way to give them comfort is by actually creating an alternative investment product for them, which uses a first mortgage over real property as the security, because that is a very, very strong form of security in Australia. Yep. If you've had a look at the Australian property market over the last 50 years, the deepest it has fallen is about 23% in its worst times. And if you look at the stats over COVID, for the residential market across all of Australia through COVID from March to September, it only dropped 1.5%.
Yeah.
And if you look at the market now and you read the paper, the resi market has certainly lit up again.
Yep.
So our logic was, well, if you've got your money in the bank then at 2.5%, and we can give you, say, 8 or 9% secured by a mortgage, surely that is a reasonable risk for you to take. And that was the thesis that built the business. So we went about using our personal connections to go effectively build a small investor base. But over the course of the 3.5 years that now we have been going, we probably have about 300 registered investors, ranging from financial institutions like investment banks, property funds, to family offices, all the way down to individuals. And all of those have been built by word of mouth. Now, for the institutions, it's really about getting a product that has got a yield, and being able to use that yield with their clients in some other way. For the property funds and the family offices, it's really just about diversifying and getting a decent return. And for the self-managed super funds and the individuals, it's a very clean annuitized yield, which is a great alternative to having your money in the bank. So we don't say to anybody, give your money to Zagga instead of giving it to anyone else. We're saying, use the cash portion of your asset allocation in your investment portfolio to use an alternative lender such as Zagga, provided you're happy with their credentials, to get a much better yield on your money than you're getting in the bank.
That is one of the best explanations I've heard of investing in a product like yours ever. Alan, stay with me. We'll be back in a minute. I'm talking to Alan Greenstein, Chief Executive of alternative lending platform Zagga. Crowdbank, the Japanese crowdfunding platform,
Yes.
has just invested as well, up to $50 million. Can you
Yes.
explain that one?
Sure. So interestingly enough, Crowdbank is a classic peer-to-peer lender, but again, via an investment mechanism. So Crowdbank is a Japanese bank. It's a registered financial institution, and they have built a database of something like 36,000 Japanese investors who give them money through their various funds, and Crowdbank goes and invests that money in property loans across the world. Now, the Japanese have always had a fascination with Australia. We've known this for a long time. I mean, we're kind of on their doorstep, and they love the Australian property market. They like it for a few reasons. Number one, it's a very buoyant market. As I've said, even when it goes down, it doesn't go down for long. And we've all heard about this bubble that's got to burst, but the bubble has never yet burst and is unlikely to burst. And that's not giving legal advice. That's just my opinion. But I think the bubble is there to stay if it actually is a bubble. But the market is strong. Secondly, it is a very well-developed and sophisticated and regulated market. You know, you can register a mortgage today on PEXA. It takes literally seconds for everything to happen. You can get an electronic mortgage. There's a lot of insight and depth into the market. You can get lots of information. And we have a very robust legal system that protects that. So the Japanese like that level of sophistication, and they like that level of development and complexity. So they've always been looking for the right vehicle through which to enter the market. Now, they came across us really because of our platform. And at this point in time, if I can just kind of digress for a second to tell you a little bit about our platform, it'll help me answer the Crowdbank question. When we started life in Zagga, and our sister company is actually a New Zealand business that used to be called LendMe, but which is now called Zagga, they built the original platform. And that platform was built to comply with the New Zealand regulator, who actually has a peer-to-peer license. Australia doesn't really have a peer-to-peer license. There is kind of a white paper that ASIC publishes about being a marketplace lender, but there's no specific licensing. And I took the view when we got the business going that if we were going to be successful in attracting investment, we needed to comply with the highest levels of compliance that we could. So we needed an almost bank-grade credit license. And number two is I wanted a highly flexible structure. I did not want our investors to have to come in through a special purpose vehicle or a unit trust where they're effectively barred or blocked from getting to the underlying asset. So we created a very interesting structure called a fractional lending trust, where effectively the investor in the Zagga loan sits in a sub-trust with all those other investors in that loan and the security. but can actually access the underlying security if that's what they want. So there's a tremendous amount of flexibility and transparency and integrity around that structure.
And presumably, as the sector grows, that structure will hold you in good stead because regulators will start thinking more about the marketplace lending if it grows.
So we definitely consider the structure to be one of our key strengths and one of our unique propositions. And it's not an easy structure to put in place. And it is an expensive structure to maintain, especially when it's surrounded by its own standalone credit license and its own standalone financial services license. So coming back to Crowdbank, the fact that we can house them in the structure and effectively give them certainty as to the loans they're invested in and access to the underlying loan, whether they're solely invested in the loan or whether they co-invested in the loan with one or many other investors, gave them a lot of comfort. And I mean, this Crowdbank deal, we did it during COVID. I always tell my colleagues we probably could have done it in 2 flights to Japan, but it took about 11 months over Zoom with Japanese translators and all these kind of things to make it happen.
Yeah, very difficult.
The thing I think that got them over the line at the end was, the structure is just a very, very comforting structure for an investor.
Fantastic. Look, for anyone who is looking for a loan who is able to provide a first mortgage on their home, what Zagga.com.au, what's the best way to get to you guys?
For sure. Just let me say we don't do it on residential. So none of the loans are actually residential.
Secured by, I meant.
All of these loans are commercial or industrial properties. We're not a home mortgage lender. We're a first secured lender for business purposes.
So if there is a business out there who thinks they fit that bill, how do they get in touch with you?
1301 Zagga or Zagga.com.au or info@Zagga.com.au.
Fantastic. Alan, thank you very much for talking to Fear and Greed and explaining it so clearly.
Thank you, Sean. It's been a pleasure. Thank you for having me.
That was Alan Greenstein, Chief Executive Officer and co-founder of Australian alternative lending platform, Zagga.